In this video presentation, we're going to look at how to record merchandise transactions under the periodic inventory method. Please open the document in the Documents section for Recording Merchandise Transactions Periodic Inventory Method. We are going to be looking at 1 month's worth of transactions and recording journal entries under the periodic method, contrasting those with the perpetual method. Let's take a look at the first 3 transactions, followed by the first 3 journal entries. January 5th, purchased $45,000 of merchandise on account, terms 210, net 30. January 8th, returned merchandise purchased on January 5th, $1,000. January 15th, paid for purchase of January 5th, less return of $1,000 and a discount. First, we recorded our purchase. Here is the periodic inventory journal entries. Here's the perpetual inventory journal entries. Under the periodic method, we use the account purchases. Under the perpetual method, we use merchandise inventory. So recording the purchase is purchases and accounts payable for $45,000. On January 8th, we returned some merchandise. We have a new account called Purchase Returns and Allowances. Before, we were using merchandise inventory. We have accounts payable, $1,000, purchases, returns, and allowances, $1,000. On January 15th, we paid within the discount period. In the periodic system, we use the purchase discount account for our discount. And of course, perpetual, we had only used merchandise inventory. Let's take a look at the next 2 transactions, followed by the 2 journal entries. January 18th, sold merchandise on account, $14,000, 110 net 30. The cost of merchandise sold was $11,000. January 21, received merchandise returned on account, $2,000. The cost of merchandise returned was $1,700. Note here, we are dealing with a sale. Under the periodic inventory system, a sale is very simple. It is accounts receivable and sales. Remember, under perpetual, that's where we had the 2 journal entries for the single transaction. Periodic, we only have the single journal entry. On the 21st, we had a return, and here we use sales returns and allowances and accounts receivable. This part's the same. And we do not have this in the periodic inventory system. We do not have the merchandise inventory need, because we're going to do that at the end of the accounting cycle. Let's take a look at another 2 transactions, followed by their journal entries. January 22nd, purchased merchandise, $25,000, terms, FOB shipping point, 215 net 30, with prepaid freight of $750 added to the invoice. January 28th, received payment from sale on account, January 18th, less return, 21, and discount. Here we're dealing with 2 types of transactions. We have our purchase transaction, and then we have a sales discount payment on a sale. So under the periodic method, when we purchase an item and we pay for freight, we have 2 separate accounts for that, and it goes into our accounts payable. Perpetual, you remember, everything just goes into inventory. Now notice that the cash, sales discounts, and accounts receivable, that's the same. It's the same for both periodic and perpetual. This is our last transaction we're going to look at. January 29th, received $17,800 from cash sales. The cost of merchandise sold was $12,600. Well, under the periodic system, we have cash and sales, $17,800. Perpetual, we have the cash and sales with the addition of the inventory piece. Add the inventory piece. Let's talk about adjusting entries. Under the periodic inventory system, since we calculate the cost of merchandise sold, cost of goods sold at the end of the accounting cycle, into the period, we don't have to make any adjustments to it. It already takes into account any theft or loss due to miscounting, mishandling. It's already captured. Under the perpetual inventory system, however, because it's continually rolling and continually moving, when we do a physical count, we need to adjust it. And oftentimes we call this an inventory shrinkage adjustment. With regards to closing entries, we've added more accounts that require closing. So our credit accounts are debited to the income summary, and the new additions become purchase returns and allowances, purchase discounts, and merchandise inventory. The debit accounts are credited to the income summary, purchases, freight in, and merchandise inventory, and also the sales returns and allowances and sales discounts.